when you're talking about what's the magical level where the stock market falls apart.
If we bring Russia back in and Russia ramps production, are we going to count that increased Russian production as part of Ukraine deal, as part of our 3 million barrels a day? Maybe.
I think there's a 15 to 30% drop coming in the equity markets. And I look at Trump's term like a 2-year term, not like a 4-year term.
We should be taxing foreign nations to enrich our citizens.
This is the thesis for my 2-year longs in gold, silver, copper, shit that Dennis Gartman used to say hurts when you drop it on your foot.
China's going to take $12 trillion of their ball that is currently sitting between initial capital and gains in the NASDAQ at all-time high valuations.
People say that what he's doing is illegal, and some of it might be. I know the USAID stuff is not illegal.
I don't know that stuff well enough other than to know, like...
Welcome to The Future's Edge. I am Iuorio. That's Bob Iaccino. Today we have one of our favorite guests, Luke Gromen of Forest for the Trees, author of the Mr. X interviews, not just Volume 1 and 2. Thank you for joining us, Luke, but mostly thank you to you guys. This show has exceeded any expectation we had as far as broad appeal, viewership, and it's all because of you guys. Thanks for the DMs, the retweets, all the support you've given us. Special thanks to our sponsors, Hardcore Italians. Go on the website. You will love it. Every product there cracks me up. If you use our promo code, you get 15% off. Our promo code is, Bobby, what is it?
FU.
And that stands for Finance Unfiltered. I don't know what you people are thinking, but it's not what you thought it was. Also, Independence Arc, farm to table, grass-fed, grass-finished beef. We all know that we're eating crap from these big mass-produced food company. Why do we do that? Why don't you go to a small farm-to-table, grass-fed, grass-finished beef? Independence Arc in Arkansas is a perfect place to start, and it's at a reasonable price.
The Hardcore Italians website, if this comes out before St. Patrick's Day, Chicago was one of the biggest hubs of St. Patrick's Day celebrations. They dye the river green and all that. And I actually went and paid like $5 back in the day to have a shirt made that was mostly white, but had green lettering that said St. Patrick was Italian, you're welcome. Because St. Patrick's family came from Roman aristocracy. They were by no means Italian, obviously. But Hardcore Italians does some really funny St. Patrick's stuff for Italians or Italians in your life as well.
Luke is an important man. We have him here. Okay, so Luke, I want to start out with a question about the bond market. So the bond market, is there a chance that the global appetite for our bonds, despite the fact that people think we could be running bigger deficits if tax cuts come through, that global appetite for our bonds could be picking up because of the cuts or the alleged cuts that are happening from the new government?
The short answer is yes, it is possible. I don't know how likely it is, but it's possible. I think the messaging you're getting from this administration very clearly is designed to contain 10-year yields at attractive levels, right? So whether it is Bessent and Trump literally saying 2 weeks ago, we're focused on the 10-year, whether it is Bessent and the quarterly refunding, which I thought was a huge signpost, right? Of, for 2 years, Bessent, Druckenmiller, a lot of the street have been sort of beating on Yellen about why did she pull forward issuance? She should have termed it out when she had a chance. And what we've been saying for that entire time is, to me, there's two most likely possible explanations why Yellen hadn't termed it out. And that was she was stupid and didn't know any better, which struck me as highly unlikely, or the fabled, deepest, most liquid market in the world is not very deep and not very liquid at the long end. And when I then layer in the fact that the Fed still has not sold on net a single 10-plus year treasury bond since 2010, there's one conclusion. They didn't term anything out because they couldn't, because they would have quickly taken 10-year yields to the sort of the Maginot line, right? Of like, if it gets to 5, like every trader I talk to, like the 10-year goes over 5, everyone's selling everything and buying dollars and probably buying gold, right? So
yeah. Okay, so hold it. So, and we saw a glimpse of this in like 5 different auctions over the last 18 months, right? Where they did have money in there and they couldn't sell as many as they want. So do you though then equate this? And I'm not trying to always look for the boogeyman and everything. I swear to God, except when there really is a boogeyman that exists. Is the fact that she just said, okay, let's forget about that problem and just go to reverse repo, go to everything short term. Is that the equivalent of like salt in the fields as you're leaving the enemy's ground and saying, okay, now this is your problem?
I think it was so much salting the enemy's fields as sort of like when you're getting overrun, like you're not sort of doing any order of operations. You're just sort of, lining up ammo and mowing them down where you can see them. And I think it was really just pragmatism on her part. Basically, this is where the demand is. Slashing spending isn't an option for a number of reasons. So I think she was just doing what she could to keep all the plates spinning. I don't think she was doing it with sort of any maliciousness. With that said, to tie it back to your original question, there clearly seems to be an awareness from this administration of A, the market isn't as liquid out there at the long end as we thought before we were in this seat, because otherwise they would have maybe tried to term some out. B, they were talking about the 10-year specifically. And then C, you're seeing Bessent in particular with his 3 arrows basically try to be the duration whisperer, right? It's get oil down because then duration will come down. Cut spending because the hope is we can doge spending down and reattract a market bid at the long end. And then there's some other things that have begun being floated out about monetizing the balance sheet, the asset side of the government balance sheet to put it to work, and we can sort of dig into some of those things. It can, in theory, work. Where it starts to get really tricky is when you sort of, and there seems to be very much we're almost being propagandized again. Like throughout my career, there've been periods of time, it's like all you hear from everybody in financial media is the same thing, right? And this is another one of these instances of, we're going to manage a 10-year and they're going to cut spending and they're going to doge and government efficiency and we're going to keep yields down. And that's fine, but it's a multi-body problem where there's some things that are mutually exclusive. So, I was in Colorado a few weeks ago. I had dinner with shale guys. They were very clear that major U.S. oil companies are not going to invest in American shale to grow production at less than 70. And so when I hear Bessent saying, well, we're going to get it to 50 and that'll fix the bond market, that's why I say, yes, in theory it works. If he can get it to 50, yes, I think that will help absolutely. But at 50, you're going to have, 8-9 million barrels a day of shale that is already flat to down in terms of just the geological roll-off. There are either geological things that he's just saying, you know what, I'm not going to worry about that, and I'm going to try to, jawbone the bond market, foreigners back into the bond market and jawbone oil down and see what I can do when paired with Doge. I think there's also probably, if you note when he says I want 3 million barrels of oil equivalent by 2028, I think barrels of oil equivalent are probably, the equivalent is probably doing a lot of work. So last week we saw a bill introduced for 450,000 barrels a day of equivalent production increase by shifting to nationwide all year long E15 ethanol. So you can get 450,000 barrels a day, but again, there's a trade-off here. You look at the chart of corn, it's, I'm not a big chart guy, but it is like, it's one of the most beautiful charts. I'm like, okay, so they're going to burn up more corn in fuel tanks. That's fine. Like that's a corn. And I'm like, holy cow, is that a gorgeous chart? Like, wow, it's been like death and it's up and it's kind of broken out on the upside. So again, can they do it? But man, okay, we're going to have to more ethanol. Is there a Russia deal? Like if we bring Russia back in and Russia ramps production, are we going to count that increased Russian production as part of Ukraine deal, as part of our 3 million barrels a day? Maybe. And in which case you can get oil down and that helps the bid for duration. The fundamental problem though, is he's got 2 sets of creditors, right? We've got oil exporting creditors and oil importing creditors that he needs to buy duration. And Saudi needs $90 a barrel for their fiscal break even. And we can see it's below that. They've been borrowing in dollars. And, you've seen some people saying, oh, look, see, they're not de-dollars. They're still borrowing in dollars. Like, that's not the point, in my opinion. The more relevant point is if Bessent takes oil to 50, MBS is going to be in there competing with Bessent to issue duration. And if you look at where he's been issuing duration, like, I got to tell you, I think I'd rather own Saudi paper with a slight premium to U.S. paper. It's all the same paper, right? Like we're backing them anyway. So why not buy the Saudi paper instead of the treasury duration? And at the same time, if you keep oil expensive enough, so that you don't have to compete with MBS to issue dollar duration. Well, then you're going to be having the Japanese selling dollar duration because they're going to be in a current account deficit and needing to effectively sell treasuries to get dollars to buy oil. And the Europeans and probably the Koreans too. So there's this fundamental, you got to get oil down. We need to Doge. And as long as those two things go, okay, great. But then if either one of those two things drive, let's say, economic weakness, right, which they should, all else equal, because industrial production will absolutely drop fast in this country, as will ISMs, if shale production rolls off. And if we Doge and we start to see what we're starting to see, for example, in housing markets, right? The NAHB today was weaker than expected. Washington real estate, we're starting to see these Zillow maps, right? Where there's like 6,000 $3 million homes all for sale all at once in the greater Washington area. If we see federal government's 25% of GDP, we are like, yay, we're cutting 10 to 15% of 25% of GDP. No one's like sort of done the math of like 25% times 15%. Holy shit, that's 4% of GDP we're going to take down sequentially. And if that drives the dollar up, well, you can call up a chart over the last year and a half, 2 years. The dollar goes up, 10-year yield's going up, not down. And again, then we'll go back to A in the whole coding sequence, which is if we get to 4.8 to 5.0 on the 10-year, traders are going to sell everything. And then you get into, bad situations economics. It is theoretically possible, but like my sort of, as you kind of talk through it, it's like, well, if you push here and then this pops out over here and you're going to have to put that over here and then you're going to duct tape this over here. And what it all tells me is it's possible, but it's not likely unless there is some sort of outside the current acceptable Overton window of policy made. And by that specifically, I mean, we're all now hearing about this gold revaluation thing, right? We've been talking about this for a couple of years as a possibility. An extremist, Zoltan Pozsar, has reportedly done some great work on it. He's talked about it in his former seat. Look, if we get the GDP down big overnight, or we reduce issuance, right? If we revalue gold from whatever we have it on the books at, $42 to almost 3,000 today, that's probably $850 billion that can effectively be deposited in the Treasury General account, spent. And it basically, dollar for dollar, reduces the amount of duration issuance that Besant would need to issue. And so there's this sort of, again, another contradictory thing. Where most of our careers, if I would have said to you, hey, gold's going to $3,500, where's a 10-year and where's a dollar going? And you're like, oh my God, like the world's ending, and yields, they're going to lose the long end. And the reality is, mechanically, if gold goes to 3,500 and they reprice it, or goes to 4,000 and they revalue it and put that in a TGA, Trump's not going to need Besant's not going to need to issue any duration for like 2 years. And there's like you guys know, there's a mindless bid for duration that's probably, I don't know, 400 billion a year, 600 billion. I don't know what it is. It's the duration matching, pensions, insurance stuff. That stuff's going to show up and buy, whether it's at 4% or 5% or 5.5% or 3%. When you start talking about the impossibility of that three-body problem, that basically, there's three issues and you can have two, but you can't have all three, that's ultimately a fiscal dominance issue. That's a debt to GDP issue. That can be addressed by revaluing gold and reducing the duration issuance. And then you can sort of, make that all work. That opens up some other cans of worms down the line, et cetera, et cetera. But long-winded answer, but that it's theoretically possible. But then it's like, okay, once you get down to the nitty-gritty of actually executing on that, it's a little trickier.
Thank you all for watching. This was the Futures Edge podcast. I started writing stuff down about halfway through and I stopped because you started answering questions that I was writing down. So I just want to ask you some really stupid, simple ones here. To me, all of this has seemed for a while now like a just sloppy version of yield curve control. And would you agree to that? And then the second thing is, I think this 5% level is short-term fictional thing that traders pull out, just like they pull out 4 3/4 and 5 1/4 and 5 1/2 and 4 1/4. And just kind of like every 25 basis points is a critical level. And the three of us are all old enough to have lived through 10 years, much higher than this, where the economy functioned just fine. Now I understand debt and taxes and the like, that it's a completely different economic scenario. Is this a sloppy form of yield curve control that's been going on since Yellen? And is this 5% level real for some reason that you want to express, or is it just traders pulling a level out of their ass?
The first one's pretty easy. The answer is yes. It's absolutely a soft form of yield curve control. BTFP was just yield curve control for banks, right? That was, hey, the paper's trading at 70 cents and we don't want you selling it to clear out deposits because the treasury market's already sloppy. We'll swap it with you at $1, right? And at par. That's yield curve control. And what Yellen has done is effectively same kind of thing, right? And there's lots of different levers, right? There's, in 3Q22, we saw treasury market dysfunction. We were seeing sloppy auctions. DXY's at 114, and she has a meeting in Washington and gets what we used to call on the sales desk a hey MFer conversation with our foreign trading partners. And like literally in 24 hours, she's like, the dollar's fine. And like 24 hours later, Bloomberg's like, Yellen's like, the dollar's a problem. And so like you can very clearly, like, I don't know what was said, but it was short and one-sided and probably loud. She ran the Dixie from 114 down to like 98, I think, and over the next couple 3 months by running TGA down, basically offsetting what the Fed was doing in terms of QT, and that supplied liquidity. And then we had, BTFP in 1Q23, and then 3Q23, we had sort of the same issues. And that time, sort of the way they kept the plate spinning was shifting to the front end issuance. Especially after we had that 30-year auction with like a 5 basis point tail. And I had bond guys call me going, dude, that's basically a failed auction. It's effectively been a soft form of yield curve control. Now, the 5%, is that just being pulled out of people's asses? I think it's more than that to a certain degree, simply because for whatever reason, we can sort of go back on the chart and go, we were getting into this very ugly environment at between 4.8 and 5 every time over the last X years, where you come in, you turn on your screen, the DXY's up, 10-year yields up 5 basis point, S&P's down, whatever, 1.5%. We go through and just wash, rinse, repeat every day. And that's where you start to get into this very dangerous, is it 5? Is it 5.25, where you really hit that tipping point of the debt spiral? I think that's a little less clear, but I think it's one of these things where like traders all look at 5 and go, beyond there be dragons somewhere. And I don't want to, you're better off selling what you can when you can than not, especially if you're managing a book on a monthly basis. There's just an levered book on a monthly basis. So,
but that is a hell of a reference, by the way. There be dragons being in ancient maps, areas that weren't mapped out. They'd say there be dragons in their book by Sharon K. Penman. The whole series. Did you read those? There be dragons?
I have not actually.
Fabulous book. Great reference. Okay. I want to know what exactly we're talking about here, because here's what I think we're talking about. You have to clarify for me. So I believe that there is a level of 10-year yields that's somewhere above 5%, below infinity percent, where the market feels, or the Fed feels, that they have to come back in and support the bond. At that point in time, I believe the dollar's going to get smoked. This is the thesis for my 2-year longs in gold, silver, copper, shit that Dennis Gartman used to say hurts when you drop it on your foot. And I have big positions in these things based on a thesis that the Fed could jump again. So when you're talking about what's the magical level, are you talking about the magical level where the stock market falls apart, or the magical level where the Fed says, hey, we got to get our buying shoes back on?
I'm somewhat flipped, but not really, because the issue is, and why sort of beyond there be dragons is, once you start getting over that level, stock market does start selling off. And the more the stock market sells off, it doesn't take too long until that starts to filter into consumer behavior and receipts. We can see that in 2022. The federal deficit went from $1.4 trillion in 2022 to $1.9 trillion in fiscal 23. Full employment, blah, blah, blah. Everyone was so puzzled by it. And it was very simple. It was the stock market fell 20% and was down 20% year on year for much of the year. And, non-withheld comp, stock options, stock compensation fell off a cliff. And so you had basically with, call it what we grew up with, right? In the late 90s, throughout much of the 2000s, like friggin' stocks fell 20% peak to trough, like all the time. Like that was just sort of like, it was a bad correction, but it was not like, but when that happened, the deficit didn't rise $500 billion. And that's ultimately sort of, I think, sort of the beyond the tipping point where traders don't know where that is, but what they do know is policy has been allowed to evolve such that debt to GDP is where it is. Deficits are where they are. They are structural. And so they're structurally high to start with, right? 6-7% GDP deficits. And we've allowed the markets to evolve such that effectively the treasury market is backed by the stock market on the margin by virtue of this. And you can see it. If you run year-over-year tax receipts against year-over-year S&P or year-over-year equity market cap and lag it by like 3 to 4 months, it's perfect. And so basically, that's where I think that 5%, it turns into this sort of Rube Goldberg machine of, okay, the 5 years here, it's causing things to sell off. That's fine. People, the dollar's rising. That's the other dynamic in all this that I think is really, really important. So
that's just the tallest midget theory, though, right? The dollar rising.
Well, the dollar, it's a liquidity squeeze issue, right? So it's ultimately foreigners have, again, this is unprecedented territory because of what Bernanke did after 2008. The dollar turned into a funding currency. So now there's foreigners that have borrowed $13 trillion in dollars, and they have reinvested aggregated surpluses into $22 trillion in US dollar assets. And $8.5 trillion of that is in dollars. And so, right, you're just managing a book. So if the dollar starts going higher on a slowdown in economic activity or recession, which it initially does, or if yields get to a higher level that starts squeezing them on their dollar borrowings, they've got to start, it feeds off this loop of dollar up, yields up. Once they hit a certain point, then stocks go down. Now stocks jump into the sort of, hey, as stocks go down, if stocks go down 20% off the highs and stay there in 3-4 months, you're going to start getting notification, the quarterly refundings, that issuance is going up by hundreds of billions of dollars a quarter on top. So that's going to increase supply, which is going to increase yields, which puts more upward pressure on the dollar because of the dollar borrowing. And so it gets to this very emerging market debt spirally type of action that is very binary, because ultimately it's not, well, we'll just adjust once it gets here. It's because the leverage is so high, the baseline of leverage, the U.S. net international investment position, foreigners have borrowed so much in dollars. And so it gets to the Fed trying to maintain their semblance of we're responsible, which is here, but the leverage is so great in debt, deficit, net international investment position, foreign borrowings of dollars. Once you let it go, it goes like that. And now they have to be up here. So it is ultimately comes down to a very simple decision for an investor. For an investor is, do you think the Fed will stand aside and let a treasury auction fail, full out fail?
No.
And I think there is zero chance of that. Right. So yeah. That is, everything's fine. And at some point up here, they're not going to let a treasury auction fail. And if it goes on for another couple of weeks, they will have a treasury auction fail. So then they put more dollar liquidity up here, soften the dollar. They sort of stop that machinery. That's kind of what we've been experiencing. Probably, I would argue it started in 2019 with the repo rate spike at the front end to a certain degree, but really post-COVID, when we ran up the debt and we ran up the deficits, you're now in full-on fiscal dominance. And given this dollar borrowing, $13 trillion, $8.5 trillion of treasuries that the foreigners own, and another, $15 trillion of U.S. equities, very binary, where it just once, and that's why that 5%, is it 5? Is it 4.9? Is it 5? I don't know. But is it 6? No, it's not 6. And it's probably not even 5.5. And so he who sells first sells best. If you, politically get the sense of, well, they're going to wait a little longer. Okay, I'm out. And then it self-feeds on it.
Something you've been posting quite a bit about, and actually, I'm going to say this in almost every show, I think there's a 15 to 30% drop coming in the equity markets. And I look at Trump's term like a 2-year term, not like a 4-year term, because we got midterms coming. And I think that's part of the reason he's moving so fast. And I'm not sure, I know Scott Bessent knows, but I'm not sure if President Trump knows exactly how much he's breaking with the speed he's doing things. And I'm not asking him to slow down. I'm just saying I'm not sure he comprehends it, because at the same time he's doing the things he's doing, he's saying we got to get rates down. And I'm like, yeah, it's probably not going to happen with everything you're doing. That's my opinion. Having said all that, you posted on X a while back about a significant change in the global flow of funds based on large and sustained tariffs that could be established by this government. I want to talk about that. And for those of you watching, we're going to put up slides on the final edit that are just, we're listing them as slide 1 and slide 2. And Luke, you know which is which. So you could talk about them because they will be on the screen. But it's fascinating. You could also follow Luke at X. What is it, Luke? It's at
Luke Gromen, all one word.
Luke Gromen. You can follow it. Just go back and look at his timeline and find the same thing. Or just, how about watching our fucking show? But go ahead and talk about these two slides that we're going to put up, slide 1 and slide 2, and explain what you mean about how the flow of funds is going to change. Because I think this addresses some of your detractors over the years who have said a lot of the things that you say can't happen because we have the currency and we print it.
What triggered this analysis was the commentary first from Trump about, I think he said it maybe 4 weeks ago, about the richest we ever were was 1873 to 1913 when we were financing mostly with tariffs. We didn't have an income tax. He said something along the lines of, we're going to, in fact, I'll read you exactly what he said. What he said was, it's time for the United States to return to the system that made us richer and more powerful than ever before, 1870 to 1913. Instead of taxing our citizens to enrich foreign nations, we should be taxing foreign nations to enrich our citizens. And so that led me to sort of just kind of try to map out in my mind the implied change in flows. And so what I said is slide 1 is the post-1971 dollar reserve status structure, which is essentially, you got two parties. You got the USA and you've got the rest of the world. And so I'm going to, arrows flowing. USA, we reduce tariffs. We offshore our manufacturing base. We offshore our jobs to the rest of world. Rest of world sends goods to U.S. consumers. U.S. sends dollars to the world for goods. And then the world invests those dollars into treasury bonds and U.S. capital markets, financing U.S. government deficits and helping Wall Street quite a bit. And then the U.S. collects income tax from U.S. citizens to finance U.S. deficits to pay the interest on the debt to the rest of the world. And so that structure has been what has evolved over the last 50 years as a very obvious set of winners that we've all seen throughout the course of our careers, given our ages, which is global capital, China, Washington, D.C., too big to fail banks, and specifically Wall Street, all win on a relative basis over time. And the USA, broadly speaking, and in particular, the middle and working classes and the bottom, call it 80%, get poorer on a relative basis, on a real basis over time via debt-based consumption. And our industrial base and our military, our defense industrial base gets hollowed out over time. And so when you hear Bessent, because Bessent followed up with what Trump said about, a 2% tariff that we're going to increase by, 2% per month or 5% per month until people start realizing that this is serious. And this is about a month ago, Bessent says this. Same setup. That implies a very different set of flows, right? Again, we still have the USA and the rest of the world on the two sides. So now the U.S. increases tariffs and arguably reduces the U.S. income tax. Is something that Trump has talked about and we're continuing to talk about now. The world sends dollars to the U.S. to pay for tariffs because demand is going to boom, because if they cut income tax enough, that's going to stimulate consumer demand. The U.S. then sends those dollars back to the world for goods. In theory, the world invests dollars into U.S. factories and the U.S. working class to address the growing U.S. demand as we've cut our income taxes. U.S. gives dollars swap lines or has the Fed do QE or whatever to finance existing treasuries. You could also do some sort of gold revaluation that we talked about earlier. And then if there's any surpluses left over, the world buys gold instead of treasuries with any net surpluses. Because again, just buying treasury is going to strengthen the dollar. We don't want those surpluses here. We want them to put them somewhere else. And in that scenario, global capital wins. Washington, D.C., the U.S., and U.S. citizens all do well over time. The world actually does well over time. And the winners of the last 40 years, too big to fail banks and long-term treasury holders, they get poorer over time via what's effectively financial repression. And we get to rebuild our industrial base and our defense industrial base. And so, I wrote that at the end of January, and it was interesting, in the middle of February, Bessent in his confirmation hearing said, look, it's time for Main Street to win again. Main Street has lost badly they've been done poorly for the last several years, and Wall Street has done very well. And it's time for mainstream to win again, to do well. Wall Street's still going to do okay, but just not as well on a relative basis relative to Main Street. So those changes in flows they're so fundamental. They're just it's like, if you asked a fish to describe his environment, the very last thing he would list would be the water. And same kind of thing is like when you're hearing these things about tariffs and this and that, I think we're starting to see it in markets to a certain extent. I think the gold market is telling us like, hey, everything you know about the dollar system is changing. They're not going to be recycling deficits into treasuries anymore. They're going to be recycling into some sort of neutral reserve asset.
Two quick questions. So number one, I should say the global world brings dollars into the U.S. to invest in factories to avoid the tariffs, is what you're saying, right?
That's essentially what I'm saying,
Avoid
yes.
whatever part of the tariffs that they can. And then the second part, the value of gold just continues to rise in that scenario, does it not? It's sort of, whether addressed or not, it sort of becomes a global default reserve. And do you think the world would be pro this, especially considering like what the Western world did to Russia when they invaded Ukraine by getting them off the SWIFT system, because this helps them in that scenario, right?
I think as with anything, there's going to be two sides to the argument, right? There's going to be the side that loves this dollar system, and there's going to be this side that is more than happy to change. In the same way that we've had two sides that has loved, what I would call the Robert Rubin, Larry Summers wing of Washington, right? Which for the last 40 years, what's good for Goldman Sachs is good for America. And before that, it was what was good for GM was good for America. And I think we're entering a new era where what's good for effectively the U.S. defense industrial base is good for America. And that means bondholders have to lose on a real basis. And so there's just two sides to it. And the opposite sides of those same coins in other countries, I think, will feel some of the same way. I think you're seeing some of that with Europe in the last week, right? Which is, I think they're surprised the way Vance is talking to them. It's like, listen, like, wake up, tighten up, defend yourself. We're getting out of here. The rumors that Trump has threatened pulling out of NATO, et cetera, et cetera. The reality is I didn't have room to kind of put it in that last flow of slide 2, which is one of the other signs you'd expect to see that would run parallel to this change is we got to get deficits down because, the Fed can QE and we can do some swap lines and stuff but like they're not going to buy treasuries anymore. So like the days of $2 trillion deficits are going to have to get taken out of the currency. And we're also going to have to work down deficits, which means we need to doge and we need to doge aggressively. And so it's interesting you're seeing that. I think it's all kind of part and parcel. Like the initial point that we were talking about, there's what can be done and you can map the flows. And then there's what can be executed on and how that goes. And that's a trickier conversation. Look, 2009, the PBOC came out in March of 2009 and a 3-page white paper at the BIS. You can look it up. It's in English. And it said, we need to move away we need a new reserve currency. That was the title of the paper. And it was not around replacing the dollar as reserve currency. It was about moving away from they called it, I think, credit-based currencies to something that is a neutral reserve asset like Keynes's Bancor. And so like China's been angling for this for 15, 18, 16 years, right? And so I think, and preparing for it, by the way. So I think they would be fine. I think the Russians, who obviously have been buying gold since 2008 and since, they're fine. The Indians, I think, would be fine. And I don't think the Europeans, I'm sorry to my European friends, but they haven't been serious players in any real way to have an opinion. You take your environmental and energy policy from a 14-year-old schoolgirl for long enough, and what ends up happening is you end up and you unplug your nuclear power plants and you disconnect the Russians and you end up finding yourselves where they find themselves, which is their industrial bases moving to America and they don't get invited to peace talks in their own continent.
So I may have stole this from you, but if I didn't steal it from you, let's just say I made it up. That Europe is a museum, Japan is an old folks' home, and China is a prison. So that leaves us to be the last man standing, which I think is kind of implicit what you said too. Now, by the way, so the year is 2032, and I'm now just been elected president. It's between you and Jim Bianco for Treasury Secretary. So behave yourself for the next 8 years till you can figure it out. But anyway, so you're Treasury. It sounds to me like you're saying, on balance, you like the tariffs as a perpetual motivator of flow of funds, as a potential demand booster in aggregate here. Are you concerned about any sort of transitions like that scare me? Markets hate transitions, and we know that it's...
Transition could be like the transition could be bad. I mean, that wasn't my phrase about the Japan's an old home,
then it's mine,
Europe music. Right, perfect. It's yours. And that's a perfect description, right? Which is because that's what you hear from sort of the dollar bull and the capital flow here. Where else is it going to go? And the answer is, it's all going to go to gold, right? Because what you'll hear in like that's what we're saying with these tariffs. Take that money out of here. Unless you're going to build a factory, Like people have said, oh, we got to get China out of the Western, right? The Belt and Road. We got to get them out of the Western Hemisphere. Monroe Doctrine. We're showing strength again. Yes, great. We saw it a couple of weeks ago when the Panamanians came out and said, hey, we don't want to be in the Belt and Road anymore. Great. But there's two sides to this coin that a lot of these folks that kind of bring this out never mention, which is, do you know what the single biggest Belt and Road hub in the Western Hemisphere is? It's not even close. It's multiple trillions of dollars.
What is it?
It's the NASDAQ. You're saying we want to separate from the Chinese. Yeah. They've put multiple trillions of dollars into stocks, and in particular, U.S. tech stocks. So what this is, Europe's an old, where else is it going to go? What Trump's policies with the tariffs is not the NASDAQ anymore. Take your ball, go home. And so it's interesting, right? Like, I was saying, gold is starting to see this, right? But it's not the only market. Look at the German DAX. Look at the CAC in France.
Sloan, I was wondering why. That's a great point. Yes.
Right? Like, you've got so foreigners, that whole flow, which is, dollars, stuff, they reinvest. They've been reinvest. Foreign central banks stopped buying treasuries 15 years ago, or 11 years ago. They've been buying, you can see the foreign direct investment in U.S. equities since 2014 has gone from like $6 trillion to $22 trillion. It's up 15 now. Some of that is capital gains, right? A lot of it. And a lot of that's the NASDAQ, right? So what we're really talking about here is China, because again, China is by far and away our biggest trade surplus. It's not even close. There's like China, like OPEC doesn't matter, Europe doesn't matter, Japan doesn't, none of it matters. It's all China. And so like you're hearing a lot of people say, well, we're going to take on China. Great. China's going to take $12 trillion of their ball that is currently sitting between our initial capital and gains in the NASDAQ at all-time high valuations, by the way. Where's it going to go? It's going to go into their stock market, which is ripping. It's going to go into Germany, which is ripping. It'll probably go into Japan if the Japanese will let them. It'll go into gold. It's take your money out of here. We don't, like, if U.S., the only way Trump and Bessent and Vance and Rubio can achieve what they want to achieve, which is not being dependent on China to make our defense goods to surround China in under 10 years, which Rubio said in his confirmation is a risk. You need to get all that foreign capital out. You've got to put it in a neutral reserve asset or in other people's, and that will do two things. That will weaken the dollar, and that will increase gold and make gold compete better with treasuries. And then you just got to reduce, our deficits because we can't finance all this shit ourselves. We got to, we need to save balance sheet for actual productive stuff. I think you're seeing in the markets between DEX and gold and like the biggest Belt and Road hub in the world by far is the freaking NASDAQ.
Okay,
And people are like, oh, I hate China. What's your biggest holding? Mag 7? What?
Bobby has the next question, but we've gone 38 minutes talking about this shit and never once mentioned Bitcoin. Bobby, it's your question.
I'm about to.
Okay, good.
Yeah, I'm about to. And that's because like Luke and I say Luke and I had a conversation. I asked him a question, basically, and he answered. He was talking about energy neutral assets like gold and Bitcoin. And my question was, how is Bitcoin energy neutral? And he confirmed to me that he didn't mean in terms of electricity. He meant in terms of its ties to a sovereign. Correct me if I paraphrase that wrong. But I'm having a little bit of an issue with Bitcoin lately. And I still have a holding of Bitcoin, but I've more traded it lately than held it. And part of the reason is because it's still way too correlated to NASDAQ, in my opinion. And that to me means that the buyers of NASDAQ buy Bitcoin and the sellers of NASDAQ sell Bitcoin. And number two, whatever part of the gold rally can be attributed to a safety rally, Bitcoin's not enjoying that. So in so much as you compare the two as sort of a neutral asset, where's the breakdown or where's the sort of disconnect?
It's a great question. I think you're exactly right. It is that, you call up Bitcoin and you call up NASDAQ over, probably anything under a 2-year chart. And it's going to be sort of, Bitcoin is NASDAQ with a beta of 2 or 3 or whatever. Given what I just described, which is you're seeing all the, away from what they're saying, you're starting to see it in markets, right? In terms of the outperformance of, Germany and China over our NASDAQ and gold, et cetera. The markets are acting like these flows are starting to happen. And if that's the case, from a trading perspective, like I kind of look at Bitcoin and go, yeah, I get it. Like it acts not good and probably keep acting not good. And I think ultimately what is going to occur is the Bitcoin NASDAQ equivalent of US inverted real rates in gold in 2022, right? Which was like forever. It was like in real rates up, sell gold, right? And like that was just, sometimes you got little divergences or whatever. And then in really around third quarter of 22, so, summer of 22, they, inverted US 10-year real rates and gold, like they separated and they've never been like just gone. And I think that moment is coming for Bitcoin and NASDAQ simply because Bitcoin actually is a neutral reserve asset for the people versus NASDAQ, which is effectively a sovereign one. If I was, the next month, 2 months, do I want to own, I have a big Bitcoin position. I like Bitcoin. So don't flame me, everyone out there. But with that said, like, I don't have like this immense urge to buy more here for the next month or two, just because I'm looking at this NASDAQ dynamic, which again is like, we're separating from China. Great. Do you know how many trillions of dollars need to move out of the NASDAQ if that's actually happening, which it looks like it might be? And if that happens, it's hard to, given the correlations, Bobby, that you were talking about, it's hard to say, it's going to happen now. I think it's going to happen, but I don't know if it's going to happen from 92,000 or 100,000 or 78,000. Like no conviction in that. I just understand that volatility is going to be there, what have you. But I think that separation will occur at some point this year, given what we just discussed, which is, hey, if this divorce keeps happening the way it's happening, then at some point, and maybe you start to see little signs of it, right? Last week, it came out, Abu Dhabi put, I think, $400 million and just, into the Bitcoin. That might be, as we look back in 2 years and you say, oh, wow, well, we talked about the separation and 2 months later it happened. If I had to sit here today and say, will we look back in 2 years and there was a separation sometime in 2Q25 between Bitcoin and NASDAQ, and what was the catalyst? Based on what I know now, that might be one of the catalysts, right? That's a real sovereign. That's basically oil bidding for Bitcoin instead of bidding for NASDAQ. Let's watch and see. But I everything else, from a trading perspective, I get what you're saying. Absolutely.
Yeah, that's been my problem with the Bitcoin cultists for a long time, is I keep telling to them it's a high beta NASDAQ is what it is. It's not what you guys say it is yet, even though at its core it may be what you guys say it is.
If you have to mark to market, right? Like if you look at Bitcoin over NASDAQ over a 10-year period, absolutely it is. But you're going to have whatever with the 87% implied vol or whatever the hell it is, right? Like you can't. You're managing a monthly book, like you can't survive a week with that kind of vol.
Well, I mean, I constantly have people telling me, on X, like I have been talking about the gold position I've had since November of 2022. And Jim and I have agreed on that. And I have people at X going, you should be in Bitcoin. I'm like, I don't know. It's not yet, is what I always say to them, even though I am in Bitcoin. But I like Jim's thesis on Bitcoin as to why he just buys it every single week, because BlackRock has an ETF. Now, I wonder if at some point Doge is going to come in and try to do some damage to BlackRock. Jimmy, you have an actual question. I just have
No, I do.
comments.
So this is interesting to me. So far, this, by the way, the stuff you've been saying is amazing. It seems to me that you identified basically 1.5 assets that you seem to like right now. Gold with a little bit of an eye on Bitcoin aside. So my friend group is probably about 10 couples that I've been hanging out with for 50 years. Half of them have retired in the last year and a half. I'm down in the Keys right now. I'm not retired, but there are 3 different couples who I'm good friends with who are here in the same key. They're all completely retired. Now, I look back at what's happened from 2020 to 2024, and I believe the K-shaped recovery, was the hugest wealth transfer I've ever seen. I think that the asset holders did spectacularly well, right? And the people who weren't asset holders, the people who actually have to pay for shit with money out of their pocket, check to check, have been totally screwed. For all of us, which, by the way, I'm not giving the money back. I think it's unfair and immoral what's been done, but I'm not giving any money back if anyone's thinking about it. So my question is this, is that I look at my friends and people my age who are retiring. What assets should they be? You said you don't like the NASDAQ. If China all of a sudden gets out, the NASDAQ gets pummeled. Companies that do most of their business domestically, is that where your focus would be equity-wise? Or is it just gold and maybe some Bitcoin at some point in time?
I'm heavy gold, heavy Bitcoin. I'm heavy T-bills because I just like, I'm like one of the worst shorters from a timing standpoint. It's just like not how I'm wired. Like, and I'm like, I can write well, as much as I write, or I can manage a 2% short position on the NASDAQ, but I just can't do both, right? So the T-bill to me is big because I want that optionality, and it's the ballast, and it's given me a yield on my gold and Bitcoin effectively. I still really, when I hear and see the demand for anything related to electrical infrastructure in this country, I continue really good things. I've got a private equity investment there. I think industrials will do very well.
Uranium,
it makes sense to me. I don't have a strong feeling one way or another. I just don't know the supply demand fundamentals as well there, other than I think demand for uranium is going up. I just don't know what's going on the supply side in terms of, nuke power plants, data centers, et cetera. Anytime you start seeing these tech companies buying, nuke power plants themselves, I think that's a huge tell about what prospective demand for uranium is going to be, whether it shows up 6 months, 12 months, 24 months. I think Chinese equities are interesting for the flip side of what we talk about with the NASDAQ, from the standpoint of, if we are really doing this, there's trillions of dollars and the Chinese aren't going to put it in the NASDAQ anymore. And if that's the case, it's like Chinese bonds, which we've seen what Chinese government bond yields have done, and then gold, and then, Chinese equities. And, for me, a small position, because I just, quite frankly, I had a small position in the RSX ahead of the Russian whole, shebang. And I lived through a down, 60% day. And then again, it wasn't big enough to matter. I wasn't like, hey, you got to own, pounding the table on Russian equities. It's one of these things where I'm aware, like, the geopolitical situation is not getting calmer. It's getting less calm. And the other issue is like, if I want exposure to China and I want it because I'm looking at this flows, I'd rather just, on the margin, I can probably capture half or 60% of the flow to China benefit by just owning gold, because that's what the Chinese are going to buy. And I sleep better, and I control it, and I don't have to deal with any of the sort of, geopolitical crap. And oh, by the way, if the geopolitical crap gets worse, it's going to be better for gold than it is for Chinese equity. So the rest of it's in kind of just some if I own some gold miners.
Well, here's something I alluded to a second ago, because it sounded like the thesis and the flow of funds and putting the puzzle together would be a case for the Russell 2000 companies that did most of their business within our shores and weren't susceptible to the big flow of funds. Saying if domestically, but you didn't say that. Is there a reason?
No, I just didn't think of it. But I agree with your premise that they should benefit. I mean, I think there's been, obviously we've had sort of this passive funds flow that has been a big driver to some of this as well. We know the passive funds flow, but what's changing is this recycling of capital. We don't want it in the NASDAQ anymore. If we want to build stuff, it's got to go into gold, or it's got to go where it came from. And the dollar will be the release valve.
So back to what I said about Trump having 2 years, and maybe even a little bit less than that. What does success look like to you? So part of my thesis about that 15 to 30%, and after this conversation, I might say 25 to 35%, but the drop in the equities that I believe is coming. I've been telling people that if I'm right about the bigger part of that drop, so 25 to 35%, that's a multi-generational buy. And the reason I say that is because that means that Trump and Elon Musk and J.D. Vance and Marco Rubio have had tremendous success absolutely flipping the government upside down and shaking it out to get some of that money out. What does success look like that would make that sell-off, if it came, a multi-generational buy from a perspective of what the administration is doing now? People say that what he's doing is illegal, and some of it might be. I know the USAID stuff is not illegal.
I don't know that stuff well enough, other than to know, like, I'm sort of a relativist on that, where it's like, okay, well, technically it's illegal for us to go to war without a declaration of war. And the last one of those we had was December 8th, 1941. So, and I'm like this way with both the Democrats and Republicans. Like, I'm very sort of unsympathetic to either one of them. Like, oh, they're not playing by the rules. Like, really?
If you're politically agnostic, you're known for that.
The CIA, by the way, is not allowed legally to do any operations within the United States. It's illegal for them to do.
We're pretty sure they do.
I think they might, but anyway, go on.
Right. So what does success look like? I agree with your premise that it's got to happen fast for exactly the reason you said. Number one, what they're doing is highly disruptive. Number two, the midterms. And there's a lag to what they're doing, where if it's going to work, you're going to have sort of, it's the two trapezes, right? Where it's like, okay, they do these changes, and then you're going to have this period of bumpiness, which I agree. I think you get an equity sell-off and what have you. And then sort of the fundamental animal spirits kick in of, okay, my income taxes are down. Yes, I'm a corporation. My taxes are down. My after-tax income is up. There's this period of time that people are just like blocking out. Like, the United States government is 25% of GDP. People should keep saying that over and over and over until it sinks in, which is, hey, they're going to cut government $2 trillion. Let's use Elon's $2 trillion number just for shits and giggles, right? $2 trillion, that's 8.5% of GDP.
Sounds like real money.
Yeah, it's real money. Like, let's just say he can do it without cutting interest. Say there's that much fraud. I don't think there is, but let's, for sake of argument, just to illustrate the point, and the point sort of I've been making very vocally, which is you've got to follow the order of operations to have the success. So let's say they're not touching interest, right? So you could get $1.4 trillion out of the deficit by cutting rates to zero. You cut rates to zero, you issue it all in bills. There's $1.4 trillion in interest expense gone basically overnight. Stock market's going to rip, inflation's going to rip, dollar's going to tank. That's a way you could do it, but I'm not.
Not a great way.
Not a great way. It's essentially printing money. Okay, so let's assume they're not going to touch interest. Interest rates are going to stay where they are. The curve is going to reprice the way it's going to reprice. We're going to stay at sort of $1.4 trillion gross, whatever it is, in interest. Let's say they take another $2 trillion out on a $27 trillion economy. Okay, so that's, like I said, about 8%, maybe a little short, 7% of GDP. A lot of this stuff that you're cutting, entitlements, it's not like there is a vault, with money in it that they could be spending over here that they're not because they're spending it here. It's in the friggin' ether, right? It's like, they are, if they cut $2 trillion out of entitlements and other spending, it's not going to get spent. And then you're not going to issue treasuries against it, which means the issuance will go down. It should, in theory, help rates. How much will it help rates? I don't know. That depends on the dollar. If all of this bids the dollar up, then it might not help rates at all. So we take GDP down 7% sequentially. Does anybody notice what Atlanta Fed GDP's done in the last 3 weeks? It was 4.3% real GDP growth, or 4.1% real GDP growth 3 weeks ago. It's 2.3 now. It's like,
it's all happening.
The key here is that people are missing, in my opinion, is in the last 3 recessions in this country, 01, 08, 20, once GDP falls, mechanically stabilizers, fall in receipts, etc., your deficit actually increases. Deficit went up 600 basis points of GDP, 800 basis points of GDP, 1,200 basis points of GDP in the last 3 recessions. So let's throw out COVID. It was a kind of a special case. So let's just say it's 700 basis points between an 01 and an 08 recession. 700 basis points of GDP, deficit goes up. Well, you just cut 7 points of GDP, and now you go right back up 7, except you're in a recession. Now what are you going to do? And that's tricky because, by the way, who's the biggest, you have a recession, your banks have credit losses. What are your banks holding reserves? Treasuries. What are they going to be selling to offset credit losses? Treasuries competing with Mr. Besant, whose deficits are going to be, still $2 trillion because they cut $7 trillion or cut 7%. And then so that's why it's really tricky. And you have to do the order of operations, which is you got to get debt to GDP down big first. And you can do that via a big dollar devaluation, which I don't think they're going to do nominally. What I think they're going to do, and I think we're seeing the gold, all this talk about gold and the vault and the revaluation is, I think, we know for a fact gold is flowing en masse out of the UK and out of the EU into the US. We don't know who it is, but it is like happening. This is highly speculative. Take this with a friggin' block of salt. I think it is somebody around the US government or the banks or somebody who's been given a heads up. We are going to do this. Let's let free market bring the gold back. If you can have the free market bid up gold for you to 4,000, 5,000 first, and then market to market, let's just say 4,000, because let's not get too crazy. That's going to get you like $1.2 trillion, $1.3 trillion into the TGA when you market to market. You can do some things in issuance. You can buy back some debt. Practically speaking, it would have to probably be a higher number. But the point is this: they need to do something big and off the reservation, almost like QE was when you remember, oh, wait, it was like, oh, we're all going to die. We're all going to die. Then, and it was like, no, we're just going to print the money by treasuries. And we're like, wait, you can do that? And now we've all become accustomed to it. And in the same way that was outside the Overton window, I think they're going to do something with this gold thing. And I think they're going to basically buy down debt to GDP in a way that gives them more time. So you get debt to GDP down enough, you're not paying the interest, your rates are lower. Now you do the Doge, you're going to have the slowdown and the pain, but you're not going to have the collapse in the bond markets and that debt spiral we talked about earlier in the show, where you get dollar up, rates up, stocks down, and now they're discredited. Now you get sort of a classic, oh crap, a bit of a recession, stocks down a bit, 10-year goes from 4.5 to 3.75, deficits rise a bit, but then all of a sudden, some of the reinvestment and some of the deals and the peace dividend and all this stuff. And so what I think in the order of operations, what success looks like is sometime in the next 3 to 4, maybe 6 months at the longest, you get some sort of off the reservation gold revaluation, sort of balance sheet restructuring that has been hinted at by no less than Bassett himself, standing right next to Trump when he said it, that gives you, and that will be like the starting gun. And that is like, okay, now Doge, restructure. You're going to have to do some sort of hiring, right? You're going to have to come out with some sort of Manhattan project around skilled trades, right? Like you want to build all this stuff. Like anyone who wants to learn to weld, you go to school free, and in 6 months, you're coming out making 90 grand a year. And if you're not making 90 grand a year, whatever, you're below 90 grand, the government's going to make it up, stuff like that until it feeds on itself. I think ultimately then it comes down to, when we look out into the early part of next year, what's success? What's real GDP growing? What's the deficit? Where's the 10-year? Where, sort of these metrics that they're setting measurements for. Where's the dollar? What's the stock market doing? And I think you could get, $4,000, $5,000, $6,000 gold. You can get a deficit that's into, a dollar that's down in the 100 to 102 range on the DXY. You could get oil in the 60 to 70 range. You can get a 10-year that's 4 to 4.25. You can get employment that is picking up, industrial production that is picking up. You have tax receipts that are picking up, government spending that is coming down, real GDP that's starting to tick up as the baton is passed from government to private. And that's success, because now all of a sudden the worst is over. Things are really going to start humming on a lag with where that dollar is, with the lack in issuance, rates are, growth. And now you get to second, third quarter of 26, and they'll be like, he did it. We want more. We want 2 more years.
Bobby told me a second ago, meaning we're bumping up against time and our producer's got to go, because he knew I wanted to ask about 10 more questions as long as we have here. So I got to play this out. And I will say one thing too. I know there's a lot of rumors saying that I've been the guy who's been buying all that gold that's been coming into the country, and that I have a Scrooge McDuck basement that I swim in the gold. I say that I officially have no comment to that, but you can't believe everything you hear on the internet. Okay, let's just put that there too. He is Luke Gromen. Follow him on Twitter at Luke Gromen. You will not be disappointed. He says some of the things that you just go, wow, that is incredibly insightful. And for that, we thank you. I'm Jim Iuorio. That's Bob Iaccino. More than that, thank you guys. All you guys have done for the show. It's been amazing. Please retweet. Please tell your friends about it. This thing has been picking up steam and we love it. Please support our sponsors, Hardcore Italians. Go to their website. You will laugh at the stuff they sell. It's fantastic. Use our promo code for 15% off, which is FU, which stands for Finance Unfiltered, not anything else. And support Independence Arc Farms in Arkansas. Farm to table, grass-fed, grass-finished. And there's a reason that we support a small meat company, because that's what Bobby and I believe in. That's what we eat all the time, because we don't want to eat shit anymore that they've been feeding us for a long time. Thank you, Luke. Luke, got anything else to say, or just want to goodbye, everybody?
No, thanks everyone for listening, and thanks for having me on, guys. This was a great conversation as always.
Thank you. This has been The Future's Edge.